Somewhere right now, there are two people the exact same age with the exact same income. One of them has been putting money into the stock market every single month for the past 10 years. The other has been keeping everything in a savings account, telling themselves they will figure out investing later, when they understand it better, when the timing feels right, when the market looks less uncertain. 10 years from now, those two people will not just be in different financial positions, they will be in entirely different financial universes. And the gap between them will not be because one of them was smarter, luckier, or had access to anything the other did not. The gap will come down to one thing. One of them understood how the stock market works and acted on that understanding, and the other one did not. My name is Tomas, and this channel is about finance, automation, and building real, lasting wealth through the strategies that have stood the test of time. If you are new here, welcome. Hit that like button right now and subscribe so you never miss a video. Today, we are covering everything you need to know about investing in the stock market. How it works, why it builds wealth, what to buy, what to avoid, and how to get started with complete confidence. Let's get into it. Let us start at the very beginning, because the stock market is one of those topics that most people think they vaguely understand and almost nobody has had explained to them clearly from the ground up. What the stock market actually is and why it exists. The stock market is not a casino. It is not a lottery. It is not a system designed to transfer money from ordinary people to wealthy institutions. The stock market is a marketplace, a place where companies that need capital to grow can raise that capital from investors, and where investors who want to participate in the growth of great businesses can do exactly that. When a company wants to expand, to build new facilities, hire more people, develop new products, or enter new markets, it needs money to do it. One way to raise that money is to divide ownership of the business into shares and sell those shares to the public. That process is called an initial public offering. Once the shares are publicly traded, investors can buy and sell them freely on stock exchanges like the New York Stock Exchange or the Nasdaq. When you buy a share of a company, you are not lending them money. You are not making a bet on a number. You are buying a fractional ownership stake in that business. You own a tiny piece of its assets, its future earnings, and its long-term growth. If the business grows and becomes more valuable over time, your shares become more valuable too. If the business distributes profits to shareholders, called dividends, you receive your proportional share of those profits as a cash payment. That is the fundamental mechanics of stock ownership. Everything else in the investing world is built on top of that basic structure. Why the stock market grows over the long run, and why that matters for your wealth. The most important thing to understand about the stock market is not how it behaves day to day, week to week, or even year to year. It is what it does over decades. And over decades, the direction has been consistently and powerfully upward. The reason for this is not mysterious. Stock markets grow because the underlying businesses they represent grow. And businesses grow because human beings are perpetually working to solve problems, create value, develop better products, reach more customers, and generate more profit. That engine, human ingenuity, entrepreneurship, and economic activity, has never permanently stalled in any modern economy. And as long as it keeps running, the collective value of the businesses that make up the stock market keeps rising over time. The S&P 500, an index tracking the 500 largest publicly traded companies in the United States, has returned an average of approximately 10% per year in nominal terms over the past century. Through 2 world wars, multiple recessions, the Great Depression, the financial crisis of 2008, a global pandemic, and dozens of other catastrophic-sounding events that caused short-term market crashes, the long-run direction of that index has been relentlessly, consistently upward. Every single crash in history has eventually been followed by a new all-time high. Every single one. For an investor, this long-run trajectory is the most important fact in personal finance, because it means that someone who simply owns a piece of the market through a low-cost index fund and holds it through every downturn without selling is almost certain to build significant wealth over a multi-decade investing horizon. The math does not require brilliance. It requires patience and consistency. How to actually participate. the accounts, the assets, and the order that matters. Understanding what the stock market is and why it grows is the foundation. The next question is how to participate in it in the most effective way. And the answer has three layers: the account, the asset, and the behavior. The account comes first, because where you hold your investments determines how they are taxed, and taxes are one of the most powerful forces working either for or against your long-term returns. For most investors, the order of priority looks like this. If your employer offers a retirement account with a matching contribution, like a 401k, start there. Contribute at least enough to capture the full match. The employer match is a 100% return on every matched dollar before the market does anything. It is the highest return move available to any investor and should never be skipped. After capturing the full employer match, open a Roth IRA, Roth Individual Retirement Account. In this account, money grows completely tax-free, and withdrawals in retirement are tax-free as well. For anyone in a low to moderate tax bracket today, which describes most people early in their careers, this is one of the most powerful wealth-building tools in existence. The annual contribution limit changes over time, so check the current limit for the year you are in. Once those tax-advantaged accounts are funded, a standard taxable brokerage account allows you to invest beyond those limits with complete flexibility and no restrictions on when you can access the money. The asset comes second. Inside those accounts, what to actually buy is simpler than most people expect. A low-cost, broadly diversified index fund, or ETF, specifically one that tracks the total U.S. stock market, or the S&P 500, gives you instant ownership of hundreds to thousands of companies in a single purchase, at expense ratios so low they are effectively free. These funds have outperformed the vast majority of actively managed alternatives over every significant time period studied. They require no stock-picking skill, no market timing, and no ongoing management beyond the initial setup. A straightforward 2-fund or 3-fund approach, a total U.S. market index fund, a total international index fund, and optionally a bond index fund for stability, covers virtually the entire investable world at minimal cost. This structure is not a starting point to grow out of. What to avoid? The traps that destroy beginner investor returns. Understanding what to buy is only half the picture. Understanding what to avoid is equally important, because the investing world is filled with products, strategies, and behaviors designed to generate fees and excitement at the expense of the investor's actual returns. The first trap is individual stock picking as a primary strategy. Selecting individual companies to build wealth requires significant expertise, time, and access to information, and even professional fund managers with all three fail to outperform the broad market index the majority of the time over extended periods. For a beginner investor, the broad index fund eliminates this risk entirely by owning everything rather than trying to pick the winners. The second trap is reacting to market news and short-term price movements. The financial media is an engagement business. Its job is to make you feel like something requires your attention and action right now. For a long-term investor building wealth through consistent, patient index fund ownership, the correct response to almost every piece of financial news is no action at all. The investors who check their portfolios daily and adjust based on headlines consistently underperform the investors who check quarterly and do nothing. The third trap is timing the market, waiting for the right entry point rather than investing consistently. Research consistently shows that time in the market outperforms timing the market for virtually every investor over virtually every extended period. Missing the 10 best trading days in any given decade, days that frequently occur during the most volatile and frightening market moments, can cut the total return of that decade by more than half. The investor who stays fully invested through good markets and bad ones captures returns that the market timer misses waiting for conditions that feel safer. The fourth trap is high-cost investment products. Actively managed mutual funds with expense ratios of 1 to 2% annually. Annuities with complex fee structures, or investment products sold by commission-based advisors whose incentives are not aligned with the investor's best interest. In a world where low-cost index funds charge as little as 0.03% annually, paying 1 to 2% in annual fees is an enormous, compounding drag on long-term returns. Over 30 years, the difference between a 1% annual fee and a 0.03% annual fee on a $100,000 portfolio amounts to hundreds of thousands of dollars in lost compound growth. The behavior that makes everything else work, consistency over time. All of the right accounts and all of the right assets are ultimately worth nothing without the behavior that holds the strategy together over time. And that behavior is relentlessly simple. Invest a fixed amount automatically, every month, regardless of what the market is doing. Reinvest dividends. Never sell during a downturn. And let compound growth work without interference for as long as possible. The technical term for investing a fixed amount on a regular schedule regardless of market conditions is dollar cost averaging. What it does over time is equally simple and extraordinarily powerful. When markets are high, your fixed monthly investment buys fewer shares. When markets are low, that same fixed investment buys more shares at a discount. Over years and decades, this mechanical process automatically accumulates more shares during the market's weakest moments and less during its strongest, producing a cost basis that is often significantly below the long-run average price, not through cleverness, simply through consistency. The investor who invests $300 every single month from age 25 to 65, through every recession, every crash, every terrifying news cycle, and every period where everything in them wanted to stop, and earns the historical average return of roughly 10% annually, will accumulate approximately $1,800,000. Not from superior stock picking, not from market timing, not from any special knowledge or access. From $300 a month and the discipline to never stop. That is the stock market. That is what it offers, and it offers it to everyone. So there it is, everything you need to understand about investing and the stock market. The stock market is a marketplace for business ownership, not a casino. It grows over the long run because the businesses inside it grow, driven by the unstoppable engine of human ingenuity and economic activity. You participate through the right accounts in the right order. Employer match first, Roth IRA second, taxable brokerage third. You buy low-cost, broadly diversified index funds that own the entire market rather than trying to pick individual winners. You avoid the traps, individual stock speculation, reacting to news, market timing, and high-cost products. And you build the one behavior that holds everything together. Consistent, automatic, long-term investing that runs through every market condition without hesitation. The two people from the beginning of this video made the same money. One of them understood this. The other one did not. Now you do. Start today. If this video gave you a complete foundation to build on, please hit that like button. It truly helps this channel grow. And if you are not subscribed yet, click that button right now so you never miss what is coming next. See you in the next one.